All right. Well, thank you everybody again for attending. Still have some people joining here at the end, and so we might have some more people popping on. But again, I want to make sure that you know that there are a couple of functions in here that are relevant because there's so much information we're going to be covering. I might be moving a little bit quickly, and that's okay. We're going to go ahead and try to get through some good information that you can apply to your own situation and to try to have fun learning together. So we do have a questions feature. If you think of questions, you can go ahead and ask them. I may not be able to answer all of them along the way, but I'll certainly take the time at the end to be able to catch any questions that people would have asked. And, really on my end, I think this is fun. I think it's fun to be able to interact with people and to be able to coach people on their money and help them figure out all this information, all the fun tax stuff that we get to talk about today. So the presentation today is going to be recorded and will be available afterwards. And we're going to be doing a lot of these this year. I'd say at least one a month is our target this year. We're going to be doing one webinar a month, maybe more than that, hopefully more than that, because it gets us lots of practice at getting better at this. And it also keeps things in the forefront. So you're able to get a lot of learning opportunities throughout the year. That's important to us, that we're able to communicate with our clients well. We know consistently over the years, I've seen poll after poll and survey after survey of clients and why they would leave a financial advisor. And the number one reason is because of lack of communication, that the company doesn't reach out to me. There's no personal touch. I don't know the person, so we want to have lots of opportunities throughout the year. We do live events. We do events like this, like webinars. And of course, we do one-on-one meetings and calls with people. So what we're going to be talking about today is the Tax Cuts and Jobs Act. I'm going to turn my webcam off and on a little bit throughout the presentation, just so you can keep me, obviously, but you can hear my voice and we can go through a lot of the material that I wanted to make sure that was covered. This is a pretty big deal. This is the biggest tax legislation in about 30 years, over 30 years actually, back since 1986. And there have been other changes to the tax code. There have been other tax bills, but not something quite so far-reaching as this one. So we're not going to be talking about politics today, by the way. Some of you may completely disagree with the tax legislation. Some of you may be cheering and saying this is the best thing ever. We're not going to talk about that. We're just talking about the reality that, hey, this happened, and how does it apply to me? How can I take advantage of the rules and the changes in strategies so I can look at my financial plan and figure out how should I adjust, or do I need to adjust? So that's really the topic today, is talking about the changes. And then obviously we can talk about your individual situation when you're on the phone with me or in the office. We can be sitting down and talking about how does this apply to me. So anyway, I'm going to go ahead and turn my webcam off for right now. And now you should just be able to hear my voice. But today we're going to be talking about the Tax Cuts and Jobs Act, which was signed in late 2017. It was kind of an 11th hour Christmas bill that went through. There was a long time in there where I wasn't sure that anything was going to pass really in 2017, but it did get pushed through at the end. And again, it's pretty far-reaching. So the big things that we'll be touching on today, we'll get into the weeds a little bit with the details, but we'll be talking about the fact that the corporate income tax rate has come down. That probably is the most significant thing that happened, is that corporate income tax rate went down from 35 to 21%. We used to be one of the highest taxed corporate tax countries in the world, and now we end up being pretty competitive. So you've seen some reaction from the stock market, certainly. That's definitely attributed to this. I mean, there's definitely some push from that, in that corporate earnings will be increasing quite a bit after they take some initial tax hits. You may have seen this last week. Apple announced that they'll be paying tens of billions of dollars to be able to bring money back to the U.S. and to be able to reinvest it back in the U.S. There have been many companies that have, played legal games, but, games to be able to keep money outside the U.S. and avoid taxation. And so now there's an opportunity for not only them to be paying a lower tax rate, but also to bring the money back and pay a one-time tax as they do that. So it's had a pretty big impact on the stock market. Where companies will use that money, long term, that's up for debate, obviously. Do they reinvest it back in the company? Do they hire people? Do they raise pay? Obviously, lots of different opinions there on what should happen. But that's been a pretty big deal. The other thing is that individual taxpayers are going to be receiving tax benefits for sure. Most people will end up benefiting from this. Not everybody, but most will enjoy lower marginal rates, and the individual tax rates, of course, like any of these tax bills, will not last forever because you've got different administrations, you've got different Congresses, and then, of course, there are some expirations in here, and especially the individual tax rates do expire at the end of 2025 if nothing changes. So let's move on. We're going to be talking about really what are the major pieces here. And there's all kinds of nuances that come into it for sure, which I think are fun. Again, the things that apply to college planning, things that apply to retirement planning, retirement funds. So still understanding a lot of those and digging into all the analysis that's coming out of this. So we're going to talk about some techniques, certainly things that you could be doing in 2018 that might help. And then we'll take time at the end for questions. So let's take a look at the tax brackets. Just to review, and we've done tax seminars in the past as far as understanding how things are taxed or how Social Security is taxed or how healthcare impacts your taxes. But what marginal tax brackets are, what marginal tax brackets are is they are the tax that gets applied on each additional dollar of income that we earn. So as individuals, you can see in 2017, the tax brackets went anywhere from 10 to 39.6%. Will be the highest tax bracket. That's if you're single. And then the current law would be 10% up to 37% for the highest bracket, and again, for individuals. So as you can see, most people would benefit from that. They would end up seeing a net increase in cash flow because of the tax rate not being quite as high. You'll notice that the number of brackets did not change here. And at one point, there were a million different iterations of this legislation before it passed. And that was one of the objectives of the legislation, is that it would simplify the tax code. And as you'll see, in some ways it has, but in some ways it hasn't. At some point, there was a debate about lowering the number of tax brackets just to 3, but as you can see, that stayed the same. And then for married, filing, and jointly, you can see the comparison between 2017 and where we are currently. Again, this is legislation that is in place and is in place for almost everybody, would have been effective January 1st. There were a couple of things that would have happened for last year. Almost everything is January 1st, 2018 and beyond. So again, tax brackets, the percentages change the same for married, filing jointly as opposed to single, but the ranges will be different, of course, based off of if you're married or single. And then tax brackets for trusts and estates, 2017 versus current law. Then you do see some compression. You see 4 versus 5. This does not impact a lot of people. Then let's talk about capital gains. Capital gains, there was some debate at one point. I think the legislation actually enacted a flat capital gains tax where everybody would have paid 20% on capital gains. That ended up getting changed where the existing 0, 15, and 20% capital gains tax brackets stayed in place. So not a lot of change there. That one basically would be 0 for married, filing jointly, for example, up to $77,200 of taxable income. You'd be taxed at a 0 long-term capital gains rate, and then the next chunk at 15, and the highest chunk at 20%. One thing to be clear on here is what is the long-term capital gains rate applied to? And that would be for money outside of retirement accounts, and it would be for a capital increase on some kind of a sale. So let's use a couple of examples. Let's say that somebody bought some Apple stock. We'll pick on Apple here. Let's say that somebody bought some Apple stock 2 years ago, and then they sold it, probably at a big gain. They would have paid a long-term capital gains rate on that of 0, 15, or 20% because they owned the stock for a year and a day or longer. So it's very important to recognize is that the IRS is very picky on this. If you're a day early and you sold too early, that's a problem. You're going to be taxed at short-term capital gains rates, which equaled what we saw before, those brackets with the marginal brackets. So capital gains rates, 0, 15, or 20%, that would be on any kind of an increase in almost everything that you'd own outside of a retirement account. Could apply to a house, could apply to a rental property that you might sell, or stocks. There are some certain, other things that may be taxed differently, like collectibles or precious metals, but for the most part, things are taxed at the long or short-term capital gains rate, depending on when you bought it, how long you've owned it. Standard deduction. So that has been a big increase for everybody. For married, you would have had $12,700 before, and now you've got $24,000 into standard deduction. Single, it went from $6,350 to $12,000. So here's the deal: for a lot of people, they will no longer have to itemize. In fact, I think the number I saw before was that it literally would drop in half the number of people who would be itemizing their taxes. So that's probably, for individuals anyway, the thing that would have had the biggest impact is that a lot of people are not going to itemize anymore. And if you don't itemize, your taxes are probably pretty simple. There's not a lot that you'll need to worry about. The interesting thing, I think, too, will be that kind of a beneficial impact of this is that there'll probably be less cheating on taxes, because you're getting a standard deduction anyway. And it also will free up the IRS. Maybe this is good or bad, but it frees up the IRS with resources as they've been cramped budget-wise for several years. That's a lot less people that they're going to have to chase down and audit returns that might have had some itemized deductions that would be questionable. So 94% of Americans they're expecting anyway, 94% of Americans will be taking the standard deduction going forward. Only 6% will end up itemizing as a result of the legislation. One thing to keep in mind is that the personal exemptions that you used to have just for being alive. Basically, if you had a heartbeat, you were an exemption. So that would apply to kids, and that would apply to adults, workers, whoever's filing taxes, basically, whether they're being claimed as a dependent or they're the taxpayer themselves. Now exemptions have gone away. There is no exemption going forward. So you can see that that's one simplification, is that you don't have to worry about that. And again, the standard deduction reduced a lot of need to itemize taxes. Child tax credit increased from $1,000 to $2,000. And one other thing that changed too is that the tax credit is now fully refundable up to $1,400. What that means effectively is that if somebody didn't owe any taxes, they actually could get a refund, which seems kind of weird, I know, but they could actually get money back from the IRS of up to $1,400. They would just get a check, in other words. So that is one thing that definitely was a change from before with the tax credit. But another change is that you do have to provide a Social Security number for that child to receive the credit. In the past, that was some controversy around that because there could have been some cheating on that. Somebody could have just said, yeah, I've got a kid. And obviously they could have been completely fictitious, or you'd hear crazy stories about people that were claiming their dog that, they'd be calling them a dependent. So kind of interesting. I think that will probably help with that, certainly. But the child tax credit did double from what it was before. Home mortgage interest, that was another opportunity that, depending on who you are, there could be some difference there. Now, the deal here is that we used to have $1 million worth of mortgage debt that somebody would be able to deduct interest payments from. Now that went down to $750. For a lot of people, depending on where you live in the country, there may not be any impact on this. But the one thing to keep in mind is that for somebody in a really, really expensive area, say if you live in the Bay Area in California or you live in New York City, $1 million is not that fancy of a place at all. In the Bay Area, most of the Bay Area, that's a very normal house, $1 million. So a lot of people will not be impacted by this, but that did go down. Now, only $750,000 of mortgage can be counted, the interest towards that. Medical expense deductions that used to be 10%, now it's 7.5% of adjusted gross income. This one only ends up lasting for a year, but this one will help people who have really high medical expenses. And that's becoming a larger and larger issue every year. As an advisor, it seems like more people are impacted every single year by higher medical expenses. whether that be their medical premiums, of course, but also just catastrophic stuff that could be just a large amount of surgery or out-of-pocket expense that they were having to cover from medical expenses. Now the threshold has been lowered down to 7.5%. That's one of the few things that actually did apply for 2017. They made that part retroactive for 2017. So for any of you who had really large medical expenses for 2017, that will help you, possibly. And then in 2018 as well, the threshold goes back to the 10% in 2019. So we'll see by the end of this year, maybe it's one of those things that Congress goes back in and they end up extending it on later. But right now, that may only be this year. Planning opportunity, if you a lot of times people don't schedule their surgeries, but if you had knee replacement surgery or hip replacement surgery or something like that, where you maybe knew that you were going to be paying a lot of money out of pocket for that, might not be a bad idea to think about that for 2018, knowing that there's not as large of a threshold to hit, and it might not be extended by Congress. It could go back to 10% in 2019. So again, those would be percentages applied to your adjusted gross income. State and local taxes. In 2017 and before that, we had unlimited deductions, and this was one of the controversial things that made it into the legislation. Of course, depending on who you are, all this could be controversial, right? But in 2017 and before that, unlimited deductions of state and local taxes. Now in 2018, the limit is $10,000. So again, a lot of people might say, no big deal, that doesn't impact me. But if you are in a state, and those states would be about a half dozen or so, that would be California, New York, Connecticut, New Jersey, would all be taxes through the roof when it comes to their income taxes and their property taxes, sales taxes, all added together. There are a lot of people that will be impacted by this and will not be able to claim as much deduction. So that'll be interesting to see what happens in those locales, if that would motivate any change for those places to be lowering taxes. So, or even could, people could actually move, right? It could force some people to say, you know what, I've been in California forever, but this is the last straw. It's just too expensive to live here, knowing that I can't deduct all this stuff now. So there is a limit, again, up to $10,000. Could that go back? Sure. They could always change this, but for right now, that would be the limit. Estate taxes. Now, a lot of people weren't impacted by this anyway. You might look at these dollar amounts and say that, it would just be for the ultra wealthy, and that's true, actually. The estate tax, also called the death tax, is something that would apply to really large estates. And so in the past, we had about $5.5 million for individuals, just over $11 million for married. Now that's actually doubled to 11 and 22 million. So there'll be even less people impacted by this. And that does not mean, by the way, that you don't need to do estate planning. It's still very important that you would be going through and making sure that your estate is well organized, even if you think, well, there's no way my estate would ever be large enough to be applicable for the estate tax. That might be true, but it's still important to make sure that you have all your beneficiaries designated correctly, that you have a will, that you have other documents like powers of attorney and living wills, because that stuff isn't necessarily about avoiding the estate tax. Traditionally, it was. These limits used to be much lower, used to impact a lot more people. Now it impacts just a few, but you still need to make sure that all your stuff is well organized, and that's one of the greatest gifts that you can give your family, is to have a well organized estate that makes it as easy as possible for them, both financially and emotionally. I've dealt with a lot of people over the years. I've been doing this for almost 20 years right now, and met with thousands of people over those 20 years in different meetings between clients and maybe just other people that would come in and talk to me. But I can tell you there are horror stories, and we'll certainly do one of these on estate planning down the road. But I can tell you this is one that I would just caution, don't think that this means you don't need to do any estate planning. Still very important, but you may not be impacted by the estate tax. The Obamacare mandate, also known as the Affordable Care Act, depending on how you want to refer to it, but in 2017 and before that, there was a penalty for not having health insurance. Now, hear me very carefully. In 2018, you still would have a penalty if you didn't have health insurance. But then in 2019 and beyond, the Tax Cuts and Jobs Act would actually repeal that requirement. And so people are not legally required to have health insurance after January 1st, 2019. Of course, again, Congress can change this, but keep in mind that this is one of those things that, again, would be cautionary. Does this mean that people should just go out and cancel their health insurance and go without? I don't know about that. I could tell you lots of stories of people, a lot of times very healthy people, that ended up having some kind of a catastrophic health event, maybe even from an accident. And when they added up all the medical bills, it was in the hundreds of thousands of dollars. Now, for the people who had health insurance, they paid just a very small percentage of that, and that's really why we have medical insurance to begin with. Is not for the little stuff. It's not because you got the flu or things like that. And it's most health insurance isn't going to even cover that because you won't meet your deductible yet. This is really meant for the big stuff that could come along. And of course, some of those things could even result, depending on your situation, and you not being able to get medical care, not being able to get cancer treatment. Or get the right kind of treatment for what you want. So definitely not a license to go out and not have health insurance. It is extremely expensive, but again, why you would have it would be for the catastrophic stuff. Alternative minimum tax. This is one that was kept around. Again, another debate on this is, do we get rid of it or not? Just like the estate tax before, that was another debate. Do we just get rid of the estate tax? And they did not, of course. When it comes to any kind of legislation, there's compromise, and so we kept that one around. We also kept the AMT, or the alternative minimum tax. Not a lot of people are impacted by this, but some are. The exemption amounts go up for this next year, so less people will be impacted. But just recognize that if that's something that applies to you, that you may not be as impacted as you were in the past. Student loan interest deductions, that's one thing that stayed the same. In 2017, you could deduct up to $2,500 in student loan interest, and that one actually did stay around. At one point, they were looking at taking that away and not having that be deductible. So that one did stay around. This is really useful, by the way. I think that we talk through this stuff because if you read the news, and if you have over the last 6 months or so, it seems like every day another headline came out, Congress is looking at doing this or that to the legislation. So it's important that you're looking through the details here and understanding that maybe something like this, for example, you thought this went away, actually it got retained. 529 plans. This is one that a 529 plan is a college savings plan. For those of you who are not familiar with this, the benefit of 529s is that they're a way that you can contribute towards somebody's higher education expenses in the past. And the benefit being that your dollars going into the 529 plan are not deductible, but when they come out, as long as they're used for higher education expenses, with some exceptions, it would come out tax-free. And so it can be a very effective way to build up money for higher education. So that's changed this year and may not impact a lot of people, but for some people it may have. Now these plans can be used, distributions can be used for private elementary, secondary school expenses, up to $10,000 per year per student. So for any of you who have kids or grandkids that go to private school, or you were considering that, it could be an effective place to save up for that. If you use your state's plan, we're in Colorado here, but other states, this can apply too. If your state allows a state income tax deduction to make the contribution to that state's plan, that could be effective for you. It may be a really smart move to make the contribution, take the state income tax deduction as it goes in, and then leave the money in there, take it out tax-free for the kids' expenses. So you could be using it every year. In other words, even if you've got the cash and you're not really saving up for some future event, you could actually be getting some deduction and some tax relief based off of those expenses. I'm going to pause here just for a second and take a look and see if we've got any questions. I don't think we do right now, but just keep that in mind, as we do have a questions box that you can be throwing stuff out at me, and we'll see how on my toes I am today. I'll never lie to you. If I don't know the answer, I'll certainly beg off and come back and let you know that I've got an answer later on. So that's an opportunity, though. Certainly the 529s and beyond, that's one thing that is expected to stick around. It's a way that people who are paying for any kind of private education could be using the 529s. One other thing to keep in mind here, too, is the 529 plans are typically for the higher education. And if they are for higher education, they can be used not just for the tuition, but also for room and board expenses, as long as that student is at least a half-time student at the institution. They're also quite flexible in that it doesn't have to be a traditional 4-year education. It could be 2-year technical school. It could be community college. It could even be for advanced education. Maybe if a child gets a support, in the form of a scholarship or something like that, but then they're going on to medical school or law school or something like that, you can use the 529s for that as well. And again, the room and board would apply if that student was at least a half-time student. You'd be able to use it for those expenses as well as books, supplies, things like laptop computers typically would be eligible for the distributions to be tax-free. The one thing that is never included as a tax-free distribution is for transportation. So you can't go out and buy your kid a car or pay for plane tickets or something like that. That would not be included as a eligible distribution. If you take the money out and it's not qualified, it's for some other expense, then there is a penalty and tax implications. Charitable contributions, that one has stayed around, so you still get to deduct your contributions to charity. Although, again, a lot more people will be falling under the standard deduction. They may not have as much benefit as they would have before, and actually you get increased a little bit. You're actually able to make more of a deduction than you would have in the past. So charitable deductions did stay around. All these deductions, by the way, at one point or another, because I followed this pretty closely, a lot of these things were ones that were kind of on the chopping block, and at one point they were looking at just getting rid of all deductions. There would be no deductions anymore, and we'd go almost effectively to a flat tax where there were really just a few brackets. So this does look dramatically different from what it started out at, but there certainly are some planning benefits that we can look for. Now, business owners, this is something that if you're a business owner, you may or may not be impacted. Now, if you're a big business owner, right, in other words, if you're a stockholder, this is a big deal. So if you own Apple, if you own HP, if you own Walmart, any kind of a publicly traded company or just a big company, a C Corp typically is going to be our big companies. That would be the really large companies. It's not to say that a small business couldn't be a C Corp, but that's not typical. C Corps are typically going to be your large corporations. So in the past, there was a top rate there of 35%, and now it's 21%. So it's dropped significantly. Again, part of the deal there is that there is an opportunity where there's basically a one-time tax that is going to apply to income that comes back or money that a lot of these companies have been holding overseas will come back to the U.S. They'll have to pay a one-time tax. So that's one thing to watch out for this year. If you're looking at earnings reports for a lot of these companies, you might say, holy cow, they're taking all these write-offs. What's happening with these companies? And that more than likely is going to be the case, that they're taking these big hits in tax bills that are applying because they're bringing money back to the U.S. So top rate of 21% for corporations. That would be C corporations. Now, down below here, we're talking about pass-throughs. And what a pass-through would be typically an S Corp or an LLC, meaning that it's a company, usually a smaller company like Keystone, for example. You look at smaller companies, smaller businesses. Most of the businesses you'd find in your local community would be an LLC or an S Corp. So they have pass-through income, which means that they don't pay any corporate income tax, but rather the income is passed through to the individual, the owners, even if it's more than one owner, but it passes through to their individual returns. So what this means essentially is we looked at all those tax brackets before, those marginal tax brackets. Effectively, it's the same rate for an S Corp or an LLC. However, there's now a deduction that is allowed up to certain levels. There's a deduction that's allowed that does expire after 2025, but the top effective tax rate now for pass-throughs is 29.4%. So they're able to take a deduction. At one point, they were looking at making what you see above there, the C Corp. They would have applied that to S Corps as well. They also changed that. It went back to just being a deduction, which effectively brings down business owners' tax rates in most circumstances. There are also, and with one of these things, with all these legislative pieces, there's all these gotchas. One thing to keep in mind is that it does not apply to every type of business. So there are service-oriented businesses like, anything like Keystone, for example, or a service, or if you had a surgeon or a CPA, typically they do not apply the same levels of deductions to those individuals. There are limits that they're able to deduct. So it does have an impact there, certainly, in that all businesses do not get to take advantage of this. So wrapping up, and then I'm going to move to questions. The big things, so these are the 4 big things that you should know about. The fact that whether you are a business owner or an individual, you are probably going to pay lower taxes this year. There are some exceptions. I've seen, in the news, there are certain things that, this individual is actually going to pay more, but in most cases, people are going to pay less in taxes this year. Increased standard deduction means that dramatic increase in number of people that are going to be itemizing their taxes. So much less likely that you're going to be itemizing in the future. Standard deduction, much simpler when you file. 529 plan opportunities, that would definitely apply for anybody who is looking at paying for anybody's education, essentially. Now it's opened up to not only higher education, but also your elementary, middle school, high school, kids that go into a private school, for example. You'd actually be able to make 529 contributions for them as well. Just as a review there too, the person making the 529 contribution does not have to be the parent. It could be a grandparent, hint, hint, right? Sometimes I'll share that with my clients that have kids in school and say, well, you probably should let your parents know this is an opportunity. If they wanted to make a contribution to your college savings plan, they could have some tax advantages to doing that and making those gifts. And then the last one there, I said business owners should meet with their advisor and or CPA. That's pretty important. It's pretty important because everybody's going to be impacted by this. It doesn't matter whether you're young, you're old, you're working, you're a student. Everybody's going to have some impact because of this. And it's important to know how it impacts you, hopefully for the better, but also you don't want to leave any money on the table. It's one of those opportunities that we're going to get to be able to take advantage of change. And sometimes we don't like change. In fact, I'd say most people are averse to change. They kind of want things to stay the way they are. But in a lot of cases, change ends up being a good thing. And for a lot of people, the change that we're seeing from the tax legislation, there will be ways that you can take advantage of that. Again, don't want to leave money on the table. We also don't want to cheat, right? There's no value in that whatsoever. So I would never advocate that somebody cheat on their taxes, but I would certainly encourage people to use every opportunity they can to use the rules towards their advantage. So that is what I've got to talk about with you today. That's me, as you saw before. I'm going to take a look and see if there are any questions in the queue here. Let's see, we had somebody say, will a replay be available later? Yes, that is true. There will be a replay available later today, so we will publish that and get that out to clients. All right, let's take a look and see what else we can see here. Yeah, I had a couple people ask about that. Will there be replays? And yes, that's true. Let's see what else we have. We hear this will impact Social Security and Medicare. What should we do? So back to the brackets, again, that will help a lot of people. It will help a lot of people because they will be looking at lower marginal rates, and they're also looking at a higher standard deduction, so less likely that they'll have to worry about itemizing. Now, Social Security is taxed a little bit differently in that it's not all considered income. And so it kind of requires a look at it every single year. There's not a cut and dry. This is the way it always should be done. You have to look at how you're doing that year. We did a presentation last year, and we will again this year, that doesn't specifically relate to the tax bill, but it's more just an overall tax planning that's more specific to Social Security. So I'm glad that you brought that up because we should do that again. We should recycle that presentation now that we have new tax legislation to talk about strategies. the importance of that is that because you're not up to certain amounts, you're not taxed on all of your Social Security amount. Not all of it has to get it included in income. So it's important to recognize that there's some planning opportunities there to kind of plan where the rest of your money is going to come from, whether it ends up coming from your IRA or your Roth IRA or maybe some other investments. Every year we can kind of do some planning and using the rules to our advantage. So I'm actually going to turn my webcam back on. I forgot. You might want to see me again. So there I am. Let's take a look and see what else we have for questions. Anything about taxes? Let's take a look here. Let's see. Could you repost the first couple of slides of differences in the tax brackets? Yep, I sure can. Let's go back. Actually, I'll just bounce back to that slide. And there's actually two of them for simplification. You guys can tell me, of course, if you want to see something different, that I'm going to put up the married, filing jointly brackets. Oh, we misspelled brackets there. Sorry about that. We spelled it right on this page. So married, filing jointly, these are the brackets, the comparisons between 2017 and 2018. Let's see what else we have here for questions. I saw another one come in. How about sales tax on online purchases? Since July 17, 2017, Colorado collects taxes on online purchases. I haven't heard anything about that, actually, and I'll research it. I'm glad you asked the question, so I will do some research on that to see if there's any question. Yeah, it's kind of interesting. I thought about the other day, actually, because I bought something on Amazon. I don't know about, for those of you who have been on Amazon for a long time, remember how you were never taxed on anything? There was always zero tax collected. Well, it seems like more and more we're seeing that tax creep up. But overall, yeah, it's pretty likely that over time there certainly are the technology is there to be able to apply state, local taxes to online purchases based off of where that person lives. So I'll take a look. Let's see what else I can see. What other questions? I'm glad people are asking questions. I go back through and make sure I didn't miss anything. Another question was on Medicare, tax impact on Medicare. I don't think there will be any. Again, you do have the implications of hitting age 65 and being Medicare eligible. Sometimes people think before they get there, they say, well, that's great. I won't have to pay anything for my medical coverage. Not exactly true. There are still deductibles. There's still premiums that have to be paid. The only thing that you really can get out of completely paying for is Medicare Part A. So Medicare Part A is the hospital-only insurance. So there's no premium for that typically, but there are deductibles. And if that's all you had for medical insurance, it would be a little bit scary because Medicare Part A does not cover your doctor. It doesn't cover medications, doesn't cover a lot of treatments. There certainly are huge deductibles on it. So typically you would have Medicare Part A, you'd have Medicare Part B, as in boy, that would cover the physician. And then there's Part D, which covers your prescription drugs. And then there's all kinds of other letters in there that would be supplemental coverage that cover the stuff that the Part A and the Part B don't cover. There's also a Part C, just to make things more complicated. I don't know why it's C, but that would typically be a plan that you would sign up for that does not have a monthly premium, but has a lot of out-of-pocket, basically. If you have medical stuff come up, you'll be paying a lot more on those. But that's kind of the plan for somebody who doesn't want to pay a premium, and they say, I'm healthy as a horse, and I never go to the doctor except for checkups. So they might take their chances and go with a Part C just because it's not very likely in their case that they would be needing a lot of services. So you kind of have to look at that one every year or two, depending on how your health is and maybe some expectations on what might be coming up. If you know that there's going to be some things coming up as far as, like a knee surgery or hip surgery, it seems like those come up a lot. I'm 42 right now. I know I'll be hitting that someday because a lot of you have had to go through that, but it's worth it, right? And obviously you still want to be active and do stuff. So we're glad that those surgeries are available. Let me go down and look at the questions one more time here, make sure that I didn't miss anything. Let's see. We have one. Any more news on deductibility of prepaid property taxes paid in 2017? I assume you mean for 2018 taxes. So the IRS actually ruled on that, and I was impacted by this too, because I actually sent my payment in early, and it didn't help. Actually, what I read is that the IRS actually said, nope, The only amount that's deductible is for amounts billed. In other words, if you didn't receive the bill yet, which you won't until this month, but if you didn't receive the bill, even if you paid it in 2017, you can't deduct it for last year. So I tried. It was worth trying, right? But it wasn't actually something that will benefit you for last year. Let's see. You guys have great questions. This makes it a lot more fun for me than if I had to just sit here, right? Do you see any markets that will be affected positively that are worth investing in? Yeah, that's more of a market presentation. I can tell you, certainly there are going to be some sectors that maybe benefit more than others. Certainly financial institutions, I think, are going to benefit from this. Certainly any multinational companies are going to benefit from this because they'll be able to repatriate that cash, all the money that's been kind of stuck overseas, they'll be able to bring that money back. So big companies, basically big global companies, are definitely going to be a beneficiary of this. Certainly any kind of a C Corp is going to see a huge increase in their net earnings in the long run. Again, short run, you're not going to see it this year probably for a lot of them because they're taking these one-time hits in taxes to get the money back into the U.S. So temporarily, that'll be some extra dollars that drop into the coffers of the Treasury. That's not a bad thing, but long run, the taxes will be lower. Obviously, there's the fact that the dollars will be kept in the U.S. in the future. That's what they're kind of banking on, is that the tax revenues will still be good in the future, and the fact that it makes U.S. companies more competitive against overseas companies. So if I were to bet, and I'm not betting, but I certainly think that's an advantage for U.S. companies. Also think it's an advantage for any multinational companies. Any global companies would benefit from this if they're U.S. based, and certainly they're going to be much more competitive in the future. Let's see, any changes to real estate taxes? Let's see, no. Yeah, again, we talked about that as far as when they were deductible. That would be subject to that $10,000 limit, though, so keep that in mind. Those are property taxes. So if your total state and property taxes and sales taxes ended up going over $10,000, those people will be losers on this deal for sure. If you had $20,000 of taxes, you're not going to be able to deduct as much, as you would have in the past. That was unlimited. If you don't see the control panel, by the way, John pointed this out. Thank you, John. If you don't see the control panel, you probably don't know that you could be asking questions right now. We're not doing audio controls today. We're just keeping it in the control panel. So if you have anything, just jump into the control panel from go to webinar and go to the questions. There's an expandable arrow that will allow you to type a question in. And I'm just going back through to make sure I didn't miss any, because there have been a lot of questions. So this is great. I think I've gotten more questions on this one than I have in other webinars. Right, I think I have caught all of them. If I missed you, I'm sorry about that. But certainly email me. My email address is included in here. It's josh@keystonefinancial.org. And my phone number is 970-744-5408. You can call me as well. I think we did have another one come in here. I had a comment here. Weld County assesses the value of property that is due in 2018 and 2017. In that case, if you paid the property tax due in 2018, for 2018 and 2017, will you be able to deduct that on your 2017 return? My understanding is yes. That's the way I'm reading it. And obviously, I'm not a tax advisor. I don't work for the IRS, but that's what I read anyway, is that if you received the bill in 2017, if you were billed for it and you paid for it in 2017, then it would be deductible in 2017. I could be proven wrong on that, but I'm pretty sure I'm right. The IRS ruled on that basically people paying early, which would, again, apply for a lot of people that are receiving their invoices here this month. They paid early, that won't help you. You're basically going to be looking at a 2018 deduction. And again, I tried. I live in Larimer County, by the way, so we were ones that didn't get the invoices out early. I had another one said that I had read it was based on assessment, which does happen in Larimer County in the year of the tax. What I read, and I'll go back and research it again, is that it's based on when it was billed, not when it was assessed, but when it was billed. So if you didn't actually receive a demand for payment, essentially. In 2017, I don't think you can deduct it. So if you're right, then I get helped by that too, right, by paying last year. But I'm pretty sure that that's one that would not help you unless you actually received the bill for last year. So, yeah, as you can see with taxes, this is a topic. It's variable because, of course, it depends on where you live. It depends on if you're a business owner or not, whether you're an individual, whether you're retired, whether you're joined Social Security, Medicare, if you have big expenses for medical or not, if you have kids or you don't have kids. That's why pretty much always the answer is it depends. If you ask a CPA a question, they'll say, well, it depends. Same thing with financial advisors, right? You know, if you ask me a question about anything, basically, it kind of depends on the situation and how it might impact that individual. I'm going to look one more time for questions here. I've really enjoyed that, so thank you for all of that. I don't see any more right now. So we're going to go ahead and wrap it up for today. Thank you for tuning in. Again, we're going to be doing this exact same webinar multiple times throughout the year because it's going to impact everybody. So we'll be doing this topic, other topics on tax, other topics would include estate planning, and I want to hear your feedback too. So if there are topics that I could be speaking on that would be really helpful for you or coworkers or friends, certainly let me know, and I will try to incorporate them into a future topic. Again, this is fun for me. I enjoy teaching. I enjoy helping people learn about their money and how to make better decisions. So thank you for dialing in today. I appreciate you guys taking the time. As always, I appreciate your business. I couldn't do this without you, and this is my dream job. Many of you know that when I was a kid, and this is not a lie, when I was a kid, one of my favorite things to do was get up in the morning, go down in the basement, and this is little, right? I wasn't 12, 13, 15 years old. This is when I was little, but I would go down, I would dress up in a suit, and I had my office set up in the basement that had a typewriter and a phone and paper, and I went down there to do my work, right? But I thought that was fun, and it's pretty cool that I get to actually do that now in real life. So thank you for the opportunity. Thanks for listening today. I appreciate you taking the time, and please let others know if they would like a replay. I'm going to be sending that out. If people would like a replay, please fire that on to them. And the more feedback that I get that this is good and we have other topics that we can speak on, the more I get excited about doing this. So thanks again. I appreciate you taking the time. Have a great weekend, and we'll talk to you soon.